Hello friends, you're watching Finance Reads, and today we're going to discuss a book that changed the world of investing, Common Stocks and Uncommon Profits by Philip Fisher. Do you want to know which companies truly deliver long-term wealth, and how you can engage in smart investing by avoiding short-term hype and market noise? In this video, we will understand all the strategies, secrets, and wisdom of this book chapter by chapter so that you can bring a discipline, patience, and research-driven approach to your investments. So let's start and find out how you can achieve financial freedom by investing in high-quality companies. Chapter 1. Understanding a company's past and history. In Chapter 1, Philip Fisher emphasizes that it is extremely important to understand a company's past and history before investing in it. 1. The importance of historical performance. Fisher says that a company's historical growth pattern and past decisions are indicators of its future performance. Relying only on short-term price movements is wrong. Long-term investors should look at how many years a company has shown consistent earnings and growth. Example: if a company has consistently increased its revenue and profits for the last 10 years, this is a strong signal that its management is competent and its business model is sustainable. 2. Management's track record. Not just numbers, but the management's vision and capability are also important. Look at past decisions like new product launches, cost control, and employee management. Fisher says that companies with honest and skilled management deliver long-term growth. Key insight: invest in companies with a proven track record and strong management. 3. Learning from past trends. Historical data shows which strategies work and which fail. Past failures and successes indicate how the company will handle future market challenges. Practical tip: review the revenue growth rate, profit margins, and debt management for the last 5 to 10 years. Compare them with competitors and industry averages. Key takeaways: 1. Past performance is the strongest indicator of future potential. 2. Investing in companies with consistent growth and strong management is safe and rewarding. 3. Ignore short-term market noise and price fluctuations. If future potential can be gauged from history alone, what kind of indicators and metrics would you focus on to strengthen your investment strategy? Chapter 2. Scuttlebutt Research Beyond Financial Statements. In Chapter 2, Philip Fisher explains that relying solely on financial statements and numbers is not enough. 1. What is Scuttlebutt Research? Scuttlebutt research means gathering information from outside the market. Investors should seek feedback from customers, suppliers, competitors, and industry experts to know the company's real potential. Example: customer feedback reveals the quality of the product and service. Insights from suppliers and competitors help understand how strong the company's market position is. 2. Why is it necessary? Financial statements only contain a record of past performance. In long-term investing, it is necessary to understand whether the company's growth is sustainable. Scuttlebutt research reveals if the management is innovative, ethical, and committed to growth. 3. Context of Fisher's 15 points. Fisher often highlights the value of Scuttlebutt research in his 15 points. Information from insiders about new products and innovations. The integrity and competence of the management. The company's customer satisfaction and market reputation. The best way to evaluate a company's future is to talk to the people who are part of its ecosystem. Key takeaways: 1. Financial data alone will not tell you the right investment. 2. You can understand the company's real value through information outside the market. Scuttlebutt. 3. Understanding the management's vision and innovation capability is essential for long-term growth. If taking insights from insiders and industry experts allows you to identify the right growth companies, how will you decide which sources and what kind of information are the most valuable? Chapter 3. Qualities of an ideal stock. In Chapter 3, Philip Fisher explains what characteristics an ideal stock should possess so that consistent wealth can be built in the long term. 1. Qualities of a great company. According to Fisher, an investor should choose stocks with these characteristics. 1. Strong management with integrity. Management must be honest, skilled, and visionary. Leaders who made right and ethical decisions in the past can deliver long-term growth. 2. Consistent earnings growth. The company's revenue and profits should show continuous growth. Irregular or unstable growth stocks are risky. 3. Innovative products or services. Continuous innovation is necessary for long-term growth. New products, technologies, and services give the company a market edge. 4. Market leadership. The company should have a dominant position in the industry or a strong presence in a niche. Companies with a competitive advantage have high long-term potential. 5. Financial strength. Adequate liquidity, manageable debt, and a strong balance sheet. Financially strong companies can survive a recession or market downturn. 2. Fisher's core philosophy. The best stock is not the cheapest, but the one with greatest growth potential. Focus on growth potential compared to price. Do not be affected by short-term market fluctuations. 3. Practical tips. Research whether the company is innovating better than its competitors. Check the management's history, product pipeline, and customer satisfaction. Maintain a long-term perspective. Think on at least a 5 to 10-year horizon. Key takeaways. 1. Strong management plus consistent growth equals long-term wealth. 2. Innovation and market leadership are critical factors. 3. Don't ignore high-quality companies in pursuit of low-price stocks. If investing in high-quality, innovative companies builds long-term wealth, will you focus your investment strategy not just on cheap stocks but on companies with growth potential? Chapter 4. What stocks and situations to avoid. In Chapter 4, Philip Fisher explains which companies and situations to avoid to minimize investment losses and build long-term wealth. 1. Companies with poor management. A dishonest or incompetent management is the biggest red flag. Companies that made unethical decisions for short-term gains in the past fail in the long term. Fisher says to always prioritize the management's integrity and vision. 2. Companies without growth potential. Avoid companies whose products are outdated or that lack innovation. In long-term investing, only a stock with growth potential is profitable. 3. Over-leveraged companies. Companies with excessive debt are risky. Their survival can be difficult during a market downturn or recession. Invest in financially strong and conservative companies. 4. Chasing cheap stocks. Don't just run after low price or bargain stocks. Cheap stocks are often low quality and don't provide long-term growth. Fisher says that quality greater than price always applies. 5. Market hype and short-term noise. Don't pay attention to media hype, rumors, and short-term fluctuations. In long-term investing, patience and disciplined research are the keys to success. Key takeaways. 1. Avoid companies with poor management, weak financials, or outdated products. 2. Place quality and growth potential above short-term price. 3. Ignore market hype and short-term noise. If we identify the factors to avoid, will you limit your investment strategy to only high-quality long-term growth stocks? Chapter 5. Fisher's 15 Points. In Chapter 5, Philip Fisher discusses his famous 15 points, which help investors select high-quality, long-term growth companies. Fisher's 15 points. 1. Superior management. The company's management should be competent and visionary. 2. Integrity of management. Ethical and honest decisions are necessary for long-term growth. 3. Profit margins. Continuously increasing profit margins indicate that the company is efficient. 4. Research and development. Investment in innovation and new products. 5. Sales organization. A strong sales team and distribution network. 6. Customer satisfaction. Loyal and satisfied customers indicate sustainable growth. 7. Employee relations. Employees should be motivated and well-trained. 8. Cost analysis. Management should be capable in cost control and efficiency. 9. Financial controls. Accurate and transparent accounting. 10. Long-term planning. Long-term vision and strategic planning. 11. Company reputation. Positive market reputation and goodwill. 12. Competitive advantage. A unique advantage or niche leadership in the industry. 13. Market potential. Long-term demand for the products/services in the market. 14. Profit reinvestment. Wisely reinvesting profits. 15. Growth prospects. Consistent and sustainable growth potential. Key insights. Fisher says that if a company fulfills most of the criteria of these 15 points, then it is an ideal choice for long-term investors. Do not be affected by short-term market fluctuations. Focus on quality, growth, and management. If stock selection is made only by considering these 15 points, will you make your investment strategy completely disciplined and research-based? Chapter 6. Common investor mistakes to avoid. In Chapter 6, Philip Fisher explains the common mistakes that often cause investors to lose money and how these can be avoided. 1. Short-term thinking. Many investors only chase short-term gains. Volatility in the stock market is normal, but focusing on long-term growth potential is necessary. Fisher says, patience and consistency are the secrets to long-term wealth. 2. Chasing tips and hype. Relying on media hype, rumors, and friends' tips is a common mistake. Buying any stock without proper research is risky. Fisher recommends, adopt independent research and a disciplined strategy. 3. Ignoring quality. Focusing only on low price or high dividend is wrong. Investing in high-quality, growth-oriented companies is more rewarding in the long term. 4. Over-diversification. Many investors think that investing in more stocks is safe, but over-diversification dilutes the focus and returns. Fisher suggests that a carefully selected 10 to 15 high-quality stocks are sufficient. 5. Lack of research. Ignoring the company's financials, management, products, and market potential is fatal. Fisher emphasizes, proper due diligence and continuous monitoring are essential. Key takeaways. 1. Avoid short-term thinking and hype. 2. Prioritize quality and growth potential. 3. Avoid over-diversification and neglect of research. If investors avoid these common mistakes, will you achieve long-term success by making your investment strategy disciplined and research-based? Chapter 7. Developing your own investment philosophy. In Chapter 7, Philip Fisher explains why every investor should develop their own investment philosophy to become a disciplined and successful investor. 1. Importance of your own philosophy. No single strategy is for everyone. Fisher says that investors need to develop an approach according to their goals, risk tolerance, and time horizon. This philosophy protects you from emotional decisions and helps in consistent investing. Example: the philosophy of an aggressive growth investor and a conservative investor will be different. The philosophy guides which companies to invest in and when to exit. 2. Long-term focus. Do not chase short-term gains. Invest in companies with sustainable growth potential and hold them long-term. Fisher says, patience and discipline beat timing the market every time. 3. Research-driven approach. Include Scuttlebutt research, financial analysis, and management evaluation in your philosophy. This approach helps you identify high-quality companies. 4. Continuous learning. The market and companies are always changing. Fisher emphasizes that investors should maintain continuous learning and observe market trends. This helps to refine your philosophy over time. 5. Risk management. Define your risk tolerance in your philosophy. Avoid over-leveraging or impulsive decisions. Focus on quality, growth, and patience. Key takeaways. 1. Every investor should create their own philosophy. 2. Long-term focus and a research-driven approach are key to success. 3. Keep continuous learning and risk management in mind. If you prepare your own investment philosophy, will you be able to engage in disciplined investing by avoiding your emotions and market noise? Chapter 8. The value of patience in investing. In Chapter 8, Philip Fisher explains why patience is the most important quality in investment. 1. Long-term growth requires time. Fisher emphasizes that real wealth takes time to build. Invest in high-quality companies and hold them for 5-10 years or more. It is necessary to ignore short-term market fluctuations. Example: the full potential of an innovative company developing new technology may only be visible after years. 2. Avoid frequent trading. Frequent buying and selling dilute returns and increase transaction costs. A long-term perspective provides the benefit of consistent growth and compounding. 3. Patience versus market noise. News, rumors, and hype often circulate in the market. Fisher says that only patient investors can survive and profit from market volatility. 4. The power of compounding. Patience allows investors to benefit from compounding. Long-term holding plus reinvested profits equals exponential wealth growth. Key takeaways. 1. Patience is the most important quality. Do not be affected by short-term results. 2. Avoid frequent trading and invest in high-quality companies long-term. 3. Give it time to benefit from compounding and consistent growth. If patience and long-term holding create wealth, will you hold your investments for years instead of focusing on short-term market noise? Chapter 9. The quality and style of management. In Chapter 9, Philip Fisher explains why the quality and style of a company's management are critical for investors. 1. Management determines long-term success. According to Fisher, only a competent and visionary management ensures a company's growth and profitability. It is necessary to evaluate the past track record, strategic decisions, and innovation capability. Example: a company with ethical and transparent management can survive even in a recession. A company with poor management can lose profits and market share. 2. Key qualities of good management. 1. Integrity and honesty, essential for long-term investors. 2. Visionary thinking, understanding new opportunities and market trends. 3. Decisive but flexible, adjusting strategies according to changing market conditions. 4. Focus on growth and innovation, continuous product improvement and R&D investment. 5. Good employee relations, a motivated and loyal workforce which increases productivity. 3. Red flags in management, making unethical decisions for short-term profits. Lack of transparency in financial reporting. Ignoring innovation and market trends. Poor treatment of employees and stakeholders. Key takeaways. 1. Management's integrity, vision, and capability are critical for long-term success. 2. Pay attention to red flags and conduct thorough research before investing. 3. Maximum returns are achieved from companies with high-quality management through patience and long-term holding. If the quality of management is the biggest factor in the success of an investment, will you evaluate the leaders and their past decisions before investing in any company? Chapter 10. When to buy and when to sell. In Chapter 10, Philip Fisher explains when to buy and when to sell a stock so that the long-term investment strategy is successful. 1. When to buy. Fisher emphasizes that one should invest in high-quality companies with a long-term perspective. Do not make decisions based only on short-term fluctuations in the stock price. Ideally, you should evaluate the company's intrinsic value and growth potential. Tips for buying. 1. The stock is undervalued, but the fundamentals are strong. 2. The company is focused on innovation and a growth trajectory. 3. Invest for a long-term horizon, i.e., 5-10 years or more. 2. When to sell. According to Fisher, the decision to sell should not be based solely on stock performance or market fluctuations. You should sell if 1. Management has become unethical or incompetent. 2. Company fundamentals are deteriorating. 3. Growth potential is exhausted. Never sell because of a short-term price drop or market panic. 3. Avoid emotional decisions. Decisions made out of fear and greed negatively impact long-term wealth. Fisher says, patience plus discipline plus research equals successful investing. Key takeaways. 1. Buy high-quality companies with long-term growth potential. 2. Sell only when fundamentals decline, not because of market noise. 3. Avoid emotional decisions and adopt a research-driven approach. If the right timing for buying and selling decisions is critical, will you base your investment decisions on thorough research and fundamentals, rather than being influenced by short-term market noise? Chapter 11. Developing your own investment philosophy. Summary. In Chapter 11, Philip Fisher explains how an investor can prepare their own long-term investment philosophy so that disciplined and consistent investing is possible. 1. Importance of a personal philosophy. Every investor's financial goals, risk tolerance, and time horizon are different. Fisher says that developing your unique investment philosophy is necessary to avoid emotional decisions. Example: the philosophy of an aggressive growth investor and a conservative investor will be different. The philosophy guides which companies to invest in and when to exit. 2. Focus on quality and growth. Fisher emphasizes that the philosophy should prioritize high-quality companies and sustainable growth. Do not pay attention to short-term market fluctuations. Patience and a long-term horizon are the keys to investment success. 3. Discipline and research. It is necessary to follow your personal philosophy. Continuous research, scuttlebutt analysis, and management evaluation should be the core of the philosophy. This approach protects investors from impulsive and emotion-driven mistakes. 4. Adapting over time. The market and industries keep changing. Fisher says that it is necessary to adapt the philosophy over time, but keep the core principles stable. Key takeaways. 1. A personal investment philosophy helps avoid emotional decisions. 2. Focus on high-quality companies and long-term growth. 3. Discipline and continuous research should be the core of the philosophy. 4. Refine the philosophy over time but maintain the core principles. If you create your own long-term investment philosophy, will you be able to engage in disciplined investing without being influenced by emotions and market noise? Would you like me to elaborate on any specific chapter or one of Philip Fisher's key concepts, such as the Scuttlebutt method or the 15 points? Chapter 12. The Impact of Investor Psychology and Mindset. In Chapter 12, Philip Fisher explains how greatly investor psychology and mindset influence investment success. 1. Emotional discipline. Fisher emphasizes that emotions like fear and greed are the biggest obstacles in investing. Emotional decisions lead to impulsive buying and selling, which can destroy long-term wealth. Example: panic selling during a sudden market crash often leads to losses. Patience and research-driven decisions help build wealth. 2. Long-term perspective. Psychological strength means ignoring short-term market fluctuations. Investors who maintain a long-term horizon are able to benefit from compounding and sustainable growth. 3. Confidence versus overconfidence. Fisher says that confidence is a good thing, but overconfidence can be dangerous. There is always uncertainty in the market, so humility and careful research are necessary. 4. Learning from mistakes. Mistakes and failures are part of psychology. Fisher recommends taking them as learning experiences and improving one's philosophy and strategy. Key takeaways. 1. Emotional discipline and patience are most important in investing. 2. Investors who maintain a long-term perspective can build sustainable wealth. 3. Confidence is necessary, but avoid overconfidence. 4. Treat mistakes as a learning opportunity and refine the strategy. If psychology and mindset are such a large part of investment success, will you practice disciplined and rational investing by controlling your emotions? Chapter 13. Common mistakes investors fall prey to. In Chapter 13, Philip Fisher explains the common mistakes investors often fall prey to and how they can be avoided. 1. Chasing short-term gains. Many investors only chase quick profits. Fisher says that this habit destroys long-term wealth. The focus should always be on long-term growth and high-quality companies. 2. Following the crowd. Blindly following the opinions and hype of people in the market is a common mistake. Fisher recommends independent research and disciplined analysis. 3. Overtrading. Frequent buying and selling increase transaction costs and dilute returns. Patience and long-term holding yield better results. 4. Ignoring management quality. Some investors focus only on numbers and ignore management evaluation. Fisher emphasizes that strong, ethical, and visionary management ensures long-term success. 5. Lack of research. Ignoring a company's financials, products, and industry trends can be fatal. Continuous learning and monitoring are essential. Key takeaways. 1. Don't chase short-term gains and market hype. 2. Avoid overtrading and impulsive decisions. 3. Always prioritize management quality and research. If you avoid these common pitfalls, will you be able to make your investment strategy disciplined, research-driven, and long-term focused? Chapter 14. Identifying and evaluating growth companies. In Chapter 14, Philip Fisher explains how investors can identify and evaluate growth companies to build long-term wealth. 1. Definition of a growth company. A growth company is one whose profits, revenue, and market share are continuously increasing. Fisher says that high-quality growth companies must have innovation, strong management, and a sustainable competitive advantage. 2. Key factors to evaluate. 1. Management quality, visionary and ethical leadership. 2. Financial health, consistent revenue growth, strong profit margins, and controlled debt. 3. Market potential, long-term demand for products/services. 4. Innovation and R&D, investment in new products and improvement. 5. Customer loyalty, a loyal and satisfied customer base. 6. Employee relations, a motivated and skilled workforce. 7. Competitive advantage, an edge in the industry that is superior to competitors. 3. Tools for evaluation, analyze financial statements and ratios. Scuttlebutt research, get insights from industry experts, suppliers, and customers. Pay attention to long-term trends and industry growth potential. 4. Avoiding pitfalls, do not rely on short-term hype and media buzz. Do not invest only by looking at a high growth rate. Quality and sustainability must also be considered. Key takeaways. 1. In growth companies, it is necessary to look for quality, management, and sustainable competitive advantage. 2. Evaluate financial health and long-term market potential. 3. Avoid short-term hype and adopt a research-driven approach. If you properly evaluate growth companies, will you be able to prepare a strategy for achieving exceptional returns and building wealth in the long term? Chapter 15. The critical role of long-term holding. In Chapter 15, Philip Fisher explains why long-term holding is critical for investment success. 1. Patience is key. Fisher says that real wealth takes time to build. Invest in high-quality companies and hold them for years. It is necessary to ignore short-term price fluctuations. Example: compounding and consistent growth are only possible with long-term holding. Early selling often leads to regret due to missed opportunities. 2. Avoid frequent trading. Frequent buying and selling increase transaction costs and dilute returns. A long-term perspective provides the benefit of consistent growth and compounding. 3. Focus on fundamentals. The basis for deciding the holding period should be company fundamentals, not market trends or noise. Hold stocks with high-quality management, innovation, and a sustainable competitive advantage. 4. Benefits of long-term holding. 1. Compounding effect. Exponential growth from reinvesting profits and dividends. 2. Reduced stress. Can be saved from the short-term pressure of market volatility. 3. Better decision-making. Rational and research-based decisions instead of emotional ones. Key takeaways. 1. Patience and long-term holding are the foundations of investment success. 2. Avoid frequent trading and invest in high-quality companies. 3. The holding decision should be based on fundamentals, not market noise. If patience and long-term holding create wealth, will you hold your investments for years instead of focusing on short-term market noise? Chapter 16. The necessity of the Scuttlebutt method. In Chapter 16, Philip Fisher explains why the Scuttlebutt method is necessary for evaluating a company and its prospects. 1. What is the Scuttlebutt method? The Scuttlebutt method means collecting information about the company from various sources. Do not rely only on financial statements, but gather insights from industry experts, suppliers, competitors, and customers. Example: ask the suppliers of a manufacturing company whether the company makes timely payments. Take feedback from customers on whether the product quality is consistent. 2. Why is it effective? This method helps uncover hidden insights and early warning signs. Fisher says that by doing this, you can identify long-term high-quality companies. 3. Steps to use the Scuttlebutt method. 1. Learn the company's reputation and market share from industry experts and competitors. 2. Get feedback from suppliers and distributors about the management and operational efficiency. 3. Gather information from customers about product/service quality and loyalty. 4. Evaluate employee relations and workforce motivation. 4. Benefits. Deep understanding of company operations. Helps avoid market rumors and hype. Better long-term investment decisions. Key takeaways. 1. With the Scuttlebutt method, you can know the company's real quality and potential. 2. Practical insights are also necessary besides financial data. 3. Research-driven investing yields better returns and lower risk. If the Scuttlebutt method provides you with hidden insights, will you base your investment decisions not just on numbers but on real-world feedback and research? Chapter 17. Common mistakes and how to avoid them. Recap. In Chapter 17, Philip Fisher explains the common mistakes investors often fall prey to and how they can be avoided. 1. Chasing short-term gains. Many investors only chase quick profits. Fisher says that this habit can destroy long-term wealth. The focus should always be on long-term growth and high-quality companies. 2. Ignoring management quality. Some investors focus only on numbers and ignore management evaluation. Strong, ethical, and visionary management is critical for long-term success. 3. Overtrading. Frequent buying and selling increase transaction costs and dilute returns. Patience and long-term holding yield better results. 4. Following the crowd. Blindly following market hype and crowd mentality is a common mistake. Fisher recommends independent research and disciplined analysis. 5. Neglecting research. Continuous learning and ignoring company/industry trends can be fatal. You can avoid pitfalls with high-quality research. Key takeaways. 1. Don't chase short-term gains and market hype. 2. Avoid overtrading and impulsive decisions. 3. Always prioritize management quality and thorough research. If you avoid these common mistakes, will you be able to make your investment strategy disciplined, research-driven, and long-term focused? Chapter 18. Understanding and navigating market cycles. In Chapter 18, Philip Fisher explains how investors can make better investment decisions by understanding market cycles. 1. Understanding market cycles. The market always fluctuates. Bull markets and bear markets keep coming and going. Fisher emphasizes that investors who maintain a long-term investment perspective are not affected by short-term fluctuations. Investors should focus on company fundamentals and growth potential, not market noise. 2. Don't try to time the market. Market timing is very risky. Buying or selling based on short-term price changes often leads to losses. Investing in high-quality companies and maintaining a long-term horizon is the best strategy. 3. Recognizing opportunities. In bear markets, high-quality stocks can become undervalued. In bull markets, there can be overvaluation and hype. Fisher says that research and fundamentals analysis are necessary to recognize the right opportunities. 4. Patience and discipline. Patience and discipline are the biggest weapons in market cycles. Avoid emotional reactions and stick to your investment philosophy. Key takeaways. 1. Market cycles are natural. Maintain a long-term perspective. 2. Avoid market timing. Focus on fundamentals. 3. Evaluate opportunities in bear markets and risks in bull markets. 4. Patience and discipline build long-term wealth. If market fluctuations are inevitable, will you invest based on fundamentals and a disciplined approach, ignoring short-term noise? Chapter 19. Achieving long-term success with disciplined strategies. In Chapter 19, Philip Fisher explains how investors can achieve long-term success by adopting disciplined and research-driven strategies. 1. Focus on quality. Fisher says that investing in high-quality companies is the most important thing. Quality means strong management, innovation, a loyal customer base, and a sustainable competitive advantage. 2. Long-term perspective. Ignore short-term market fluctuations. Patience and long-term holding provide compounding and consistent growth. 3. Thorough research. Continuously analyze the company's financial health, products, industry trends, and management. Adopt the Scuttlebutt method to find hidden insights. 4. Avoid common pitfalls. Avoid short-term gains, hype, overtrading, and emotional decisions. Fisher emphasizes that a disciplined approach is the key to success. 5. Continuous learning. The market keeps changing, so continuous learning and strategy refinement are always necessary. Maintain core stability in your philosophy and principles, but adapt new insights. Key takeaways. 1. Focus on high-quality companies and strong management. 2. Adopt patience and a long-term horizon. 3. Make informed decisions through thorough research and the Scuttlebutt method. 4. Avoid common mistakes and emotional decisions. 5. Continuous learning and strategy refinement lead to sustained success. If you follow these strategies, will you be able to achieve long-term wealth and financial freedom in your investing journey? Chapter 20. Summary for long-term success. In Chapter 20, Philip Fisher summarizes his entire experience and insights so that investors can be prepared for long-term success and disciplined investing. 1. Focus on the long term. Fisher's ultimate advice is that patience and a long-term perspective are most important in investing. Invest in high-quality companies and hold them for years. 2. Importance of research and Scuttlebutt. Thorough research and the Scuttlebutt method always strengthen your decision-making. Focus on company fundamentals, management quality, innovation, and customer loyalty. 3. Avoid common mistakes. Avoid short-term hype, overtrading, impulsive decisions, and emotional investing. Maintain discipline and a well-defined investment philosophy. 4. Continuous learning. The market and industries keep changing. Fisher says that continuous learning, adapting, and strategy refinement are essential. 5. Wealth is a product of discipline. Building true wealth is not just luck, but the result of research, patience, discipline, and long-term thinking. Key takeaways. 1. Patience and long-term holding are the foundation. 2. Make informed decisions through research and the Scuttlebutt method. 3. Avoid common pitfalls and maintain discipline. 4. Continuous learning and adapting lead to sustainable success. 5. The art of building wealth is based on principles, quality, and rational thinking. If you adopt Fisher's principles, will you be able to make your investing journey truly disciplined and successful and achieve lifelong financial growth? Friends, today we learned through Philip Fisher's book, Common Stocks and Uncommon Profits, how you can grow your wealth with long-term investing, high-quality companies, and disciplined strategies. If you follow these principles, you will not just get caught up in short-term market noise, but will be able to grow your investments in a smart and research-driven way. If you like this video, be sure to like, share, and subscribe. And yes, tell us in the comments section which investment strategy you plan to adopt first. Stay connected with Finance Reads and learn the world's best financial wisdom chapter by chapter. Would you like me to identify the key overarching themes from all these chapters for a concise summary?